It's the 1st of October, so that means it's time for the top 10 stocks of October. And today I'm going to go through a wide number of stocks. Some of these stocks are in the asymmetric portfolio. Some of them I even recently added to the portfolio. I'll put a link in the show notes if you want access to the asymmetric portfolio. That's the premium newsletter service. But here on YouTube, I want to go through 10 stocks and why I like them. The idea of asymmetric investing is to find 10x stocks over the next 10 years. So high potential stocks, but we also want to pay a reasonable price. So I want to balance those two things. So there's a wide range of companies here, from tech stocks. I've got a restaurant stock. I even have a really great dividend stock. So if you like any of these stocks, let me know in the comments section below. Maybe give me your top 3. We'll see what everybody thinks about this list. Don't forget to subscribe here on Asymmetric Investing. And today we have a new sponsor that I want to shout out to, public.com. I'll be right back with that top 10 list. Heads up investors, interest rates are falling, but you can lock in a 6% or higher yield with a bond account at public.com. Now this is a pretty big deal, because when interest rates fall, so can the interest that you earn on your investments. But a bond account allows you to lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds. You can see on the screen what an example portfolio looks like. You know exactly what you're buying. So while other people are watching their returns shrink, you can sit back and collect regular interest payments. But you might want to act fast, because your yield is not going to be locked in until you invest. The good news is it only takes a couple of minutes to sign up at public.com. Lock in a 6% or higher yield with a bond account only at public.com/Travis. Let's start things out with Portillo's. Portillo's is a restaurant company. I really think of this as Chipotle if you would have bought Chipotle 15 or 20 years ago. It's not really at scale yet, just starting to grow outside of the Chicagoland area. What Portillo's is really known for is their hot dogs and their beef sandwiches. They've also got a really great chocolate cake. Management talks about their really wide menu being veto-proof for families. And if you've ever brought kids to any sort of restaurant, you know that somebody always has some sort of problem with almost every single restaurant. Portillo's tries to answer that by having such a big menu that they can provide something for everyone. I would also argue that Portillo's has a bit of a cult following. Even in the comment section on Portillo's videos that I've done in the past, you can see that people are extremely passionate about Portillo's if they know about this brand. The problem is, not a lot of people know about Portillo's. Most of the company's development has been in the Chicago area. That has been the case for decades now. Very, very profitable restaurants. They do about $9 to $10 million in revenue per restaurant. To put that into context, an average Chipotle does about $3 million in revenue. So a little bit bigger restaurant, but also very, very busy. A lot of them have those double drive-throughs, now doing more pickup. Just a phenomenal concept and very profitable, making about $2 million in restaurant level adjusted EBITDA. That's going to be a proxy for the cash flow that's going to be coming from each of these restaurants. But the goal for Portillo's is not to just be the business that it is today. It's to scale the business from here. Management wants to grow the store count by 12 to 15%, basically for the foreseeable future. So right now they've got about 85, 86 restaurants. They're going to be growing that extremely rapidly. They're going to be opening more than 10 units in 2024 alone. Most of those are going to be in the southern part of the United States. Texas is a huge area of growth. As they grow in Texas, they should actually improve their margins in Texas as well. If you're just delivering your food to one location, that's not very efficient. So you want to be able to have a supply chain that you're able to deliver to a number of different locations. So they're starting with the Dallas area, moving into Houston area. I think you're going to see these localized scaling for Portillo's. That's what they did in Chicagoland. So you just basically rinse and repeat all around the country in places where this kind of food is going to be popular. On the revenue side, Portillo's is really just getting to the point where it's starting to grow. And one of the challenges the stock has had recently is same-store sales. So they had pretty solid growth during the pandemic from a same-store sales basis, 5.4% in 2022, 5.7% in 2023. But in the last 12 months, so the last half of 2023, the first half of 2024, that growth was just 1.6%. It was actually a little bit negative. Now, this is something that we've seen across the board in a lot of different restaurant stocks, but investors are wondering, what is this company's economics going to look like in the future? You don't want to have negative same-store sales. But this is why we're getting a really good value. I think if you look out 10 years, Portillo's is a phenomenal growth story, not only the number of restaurants that it's going to have, but also just slow and steady growth on those same store sales. And if that ends up happening, we're getting a very, very cheap stock. I want to put this into perspective. Price to sales multiple for Portillo's, 2.1 right now. Chipotle, the company that I mentioned earlier, That same multiple is 7.6. So it's almost a quarter as expensive as a company like Chipotle. There's a ton of options for Portillo's to grow their portfolio, not only in the cities that they're currently in places like Texas and Arizona, but also growing all around the country. They've got a huge swath of growth potential in the Sun Belt. They're going to use that as tailwinds. And as there's more exposure, we should have more repeat customers. And these restaurants are just cash flow machines. Each one of them is just spitting out cash flow year after year. The other thing that I want to highlight, and this has, I think, been a drag on the stock as well, the former owner is a private equity company, Berkshire Partners. Now, this is not related to Berkshire Hathaway. Berkshire Partners own the company, bought it out. They have a separate share structure, which makes their share structure a little bit confusing, but Portillo's has been buying back those shares pretty consistently. Berkshire Partners now has a minority stake in Portillo's. And again, if we're going to use Chipotle as an example, the same sort of thing happened for Chipotle in the late 2000s. They were majority owned by McDonald's. There was a separate share structure. Some of those shares actually traded at a discount to the others despite having more voting rights. Kind of a weird market dynamic. And that dual structure was a drag on the stock. The stock started to take off when they say, hey, we're just going to combine this into one share structure. So I think that's another tailwind behind Portillo's. But this is the kind of company that I think 10 years from now, that's just going to be much more of a household name than it is today. And you're getting in at a very, very early phase in Portillo's growth story. So I love that company right now. The second one that I want to go over is Coinbase. Now, Coinbase, very misunderstood company in my opinion. Most investors think that this is a crypto company and a crypto exchange in particular. In a lot of ways, that's true. That's still what drives the company's financials. But the future of Coinbase is not just being a crypto exchange. It's not about YOLO trading like it was during the pandemic. Yes, that was an extremely profitable phase for the company, but the future is all of the services the company is building. It's the base blockchain, it's wallets as a service, it's the USDC token. They're doing smart contracts so we can do bond and stock trades on the blockchain instead of in the way that we do them today. Now, the stock market is very liquid, very cheap to do transactions, but that's not the case for a lot of different financial instruments. If you're trying to trade a corporate bond, or a specific derivative, or even a municipal bond that doesn't have a lot of liquidity, where are you going to find that liquidity? You have to call up a bank has to make a market. That's where banks make a ton of money, is making markets in very illiquid assets. The blockchain could really answer that, could provide that liquidity on the blockchain, make it publicly available, and those transaction costs could be much, much lower than we have today. There's a ton of optionality for the blockchain and for Coinbase to grow their business as a result. I want to just go through the non-exchange business for Coinbase. These are the segments of the non-exchange business. In dark blue, you have blockchain rewards revenue. Light blue is custodial revenue fees. This is going to be fees for being the custodian for a lot of the Bitcoin ETFs that have been launched recently, but they have a bunch of other services. Stablecoin revenue, that's the one that has exploded over the past couple of years. That is related to the USDC token. Other subscription and service revenue, you can see that that's kind of a catch-all, but that's been growing pretty consistently as well. And then interest income, that's a different way that they reported some of their stablecoin revenue. But those are the non-exchange revenue sources. And you can see that these are growing tremendously, essentially no revenue in 2019, up to $366 million in revenue in 2020. Over the past 12 months, just a staggering $1.8 billion in revenue. And this is the kind of business that's just going to continue to grow for Coinbase. There's really no end in sight because there's a lot of different businesses that are being built on top of the blockchain. On top of that, we still don't have regulatory clarity in the United States for how a lot of these businesses can be built. So the innovation that's going to happen on top of Coinbase, if you think about Coinbase as the AWS and the identity solution, so a little bit like signing in with Google, and the bank with that exchange piece, those are the three pieces I think you can put together with Coinbase on the blockchain. But most of the businesses and innovations haven't happened yet because we don't have a lot of that regulatory clarity. So I love where Coinbase is sitting. The valuation is still pretty expensive. Market cap currently is $44.3 billion. Enterprise value, when you pull out the cash that's on the balance sheet, $41.5 billion. Price to earnings multiple is about 33. Now, if you think that Coinbase is going to be 10 times bigger than it is today 10 years from now, I think that's a really, really reasonable price to pay for Coinbase. And that's essentially what I'm betting on, is that all the things that are going on under the surface are really only starting to show their potential for Coinbase. I think this is a company that can grow well into double digits for the foreseeable future. It's not going to necessarily be driven by the exchange business. It's going to be driven by all these other ancillary services that are starting to make money, but are only going to get bigger and bigger over time. And the moat around Coinbase's business is going to get bigger at the same time. In a lot of ways, I think the blockchain is what you should be looking at, not cryptocurrencies, because the blockchain is what we're going to ultimately be using. And a lot of the use cases are probably going to be hidden under the surface if Coinbase is successful building out wallets as a service and things like that. So that's why Coinbase is second on my list. The next company is Zillow, and like Coinbase, you're going to have to think about Zillow as what it's going to be in the future, not just what it is today. I'm going to put these numbers up here on the screen. This is Zillow's revenue and net income over the past decade. And so this doesn't look all that impressive, hovering right around $2 billion in revenue and losing money on a net income basis. Now, they are free cash flow positive when you pull out things like stock-based compensation, but not positive from a net income perspective. But what we need to think about with Zillow is what the strategy is for them being the aggregator in the housing market. And I think this is where things really get interesting for Zillow. They've had a bunch of twists and turns over the past decade. They're the place you can go and search for housing, whether you're looking to buy a home or whether you're looking to rent. The original business model was basically that they provided ad space for agents. That's still going to be the case in the future. There's still going to be that connective tissue between people looking for homes and mortgages and agents. But the business model is going to move less from advertising to actually facilitating the transaction. And here's the vision that they have for Zillow. They want this to be the housing super app. And the way that they think about this is they want it to be a place that you can go search for homes or to rent a place where you can actually get approved to get a mortgage, schedule your touring. Then you can actually do things like make an offer and buy a house, get your financing all in line, do the title search, do all that stuff that happens kind of behind the scenes or with a convoluted number of different suppliers that oftentimes the agent is doing that work. But if they can be that connective tissue for all those things in all of the individual jurisdictions across the US and even around the world, that's going to be an extremely valuable place to be. And there's going to be a number of different service providers that are going to want to plug into that. The agents is the obvious one. They're going to be the ones that are going to provide a service. Now, that's probably going to change in the future. Are they just going to be taking you around to houses? Well, you can do a lot of that work on Zillow now, but there is going to be value that they're going to be able to provide, kind of walking you through and answering questions, maybe even about a specific neighborhood, information that Zillow as a big company isn't going to necessarily know. So the business model for agents is going to change, but the volume for really good agents is probably going to go up, maybe go down for agents that aren't quite as focused. But you're also going to be able to plug in things like mortgages. You're going to be able to plug in those closing fees. I mentioned the title search. What about insurance? Even the whole closing process could be much more efficient if we were doing a lot of these things digitally. So that's the vision for Zillow, especially on the housing side. Now, on the rental side, an equally expansive vision, but it just looks a little bit different. In this case, if you're able to have all of the potential renters on your platform, which Zillow is a growing platform for renters, then the supply is going to want to be able to reach those renters. Now, Zillow could potentially be the platform where you do things like sign a lease and even make your payments. There's a lot of opportunities for them to have revenue generating opportunities in that ecosystem. And the rental business has been a phenomenal growth engine for Zillow. Look at this rental revenues growth over the past 6 or 7 years. You can see that since 2017, compound annual growth rate of 24%. That is a phenomenal growth rate and just shows the power that Zillow is starting to have on the rental side of the business. Hasn't been the core for the company for quite a while, but if they're able to get a recovery in the housing market, they're able to execute on this strategy that they have of being the housing super app. I think there's a lot of different avenues for Zillow to grow, just starting to get to that point where they could get to net income profitability, not just cash flow profitability. And the valuation isn't too bad. $14.7 billion market cap as I'm recording. Enterprise value, when you pull out cash and add back the debt, you get $13.8 billion for a multi-trillion-dollar housing market. Having a company that is in the power position that Zillow is, having a market cap of just $14.7 billion, I think that's a pretty good valuation. A ton of upside left with Zillow. Now, with each of these stocks so far, I've done a deeper dive on them on Asymmetric Investing. So I'll put a link to that in the show notes. If you're interested, subscribe. There's a free version. There's also a premium version where you can follow every one of my picks. That's where you get those deep dives. You get to see what I'm buying every single month. So I think it's a great value. And that portfolio that you can follow is also beating the market. So there have been some phenomenal picks in there following that asymmetric investing thesis. The fourth stock that I want to go through today is Alphabet. And this one I think you can keep pretty simple. Alphabet is one of the big tech companies really well positioned in artificial intelligence. Obviously, their main business is search and all the advertising revenue that goes along with that. But let's look at that because I think this is where the market is really misunderstanding Alphabet as a company. You can see this is basically the search related business, the advertising business, Google search, and then their Google network business. And you would think the way that the narrative has gone with Alphabet and with search and with artificial intelligence, that this business would be being destroyed right now, that it wouldn't be growing. But in fact, it is growing at a pretty consistent clip. On top of that, you get YouTube, where you're watching this right here, and you get all of these subscription, platform, and device revenue. This is where I think there's a lot of potential for Alphabet that's not really being appreciated by the market. As we use more artificial intelligence, yes, Apple has a phenomenal ecosystem, but the other ecosystem is Android, and that is owned by Alphabet. If we're going to start to see TPUs in Android devices, if we're going to start to see AI models in Android devices, that's most likely going to be powered by Alphabet's tools and by that Android ecosystem. So I think that's where there could potentially be a ton of growth, whether it's Alphabet selling the hardware or whether it's another hardware company that's actually making the devices and using their software. So I think that's a really well-positioned business, maybe even better positioned today than Apple is in the handset market. And the final business worth highlighting for Alphabet is the Google Cloud. And this is really where most of their artificial intelligence revenue is coming from. You can also see that this has become profitable over the last year or two, $3.2 billion in operating income over the past 12 months. That's probably not where this is going to end. I would expect the operating income margin to be more like 20 or 30%. That's where competitors are. Microsoft and Amazon are going to be the two biggest competitors in that space. But this is a business that's growing extremely rapidly. Since 2017, compound annual growth rate is 41%. The ongoing growth rate is a little bit lower than that. It's a little lower than 30% right now. But if you compound that kind of revenue growth, even if it's just 20% over the next 10 years, that's going to be a phenomenal business for Alphabet to be in. Now, the other one that I'm going to just mention briefly is Waymo. This is one of the businesses that I really like in autonomous driving that's owned by Alphabet, funded by Alphabet, still losing money, but I think it's a very clear leader in the autonomous driving space, could potentially be a very valuable business in the future. Now, you're getting all of this with Alphabet for a pretty reasonable valuation, about a $2 trillion market cap today. The price to earnings multiple on a trailing basis, a little under 24, and on a forward basis, it's 20.6. This is also not a company that's done growing. Analysts are expecting over the next 2 years, the company's going to grow at a compound annual growth rate of about 12%. I think that's probably on the low side of what Alphabet is going to be able to deliver. So a lot of pressure being put on the stock because of a lot of the competition coming into the market, particularly in artificial intelligence. But the facts on the ground show Alphabet's holding its own extremely well. They have a set business model, and I think even in AI, they're much better positioned than a lot of investors think with Google Cloud, with the Android ecosystem and all the devices that they can get their models and their chips into. I think they're much better positioned than a lot of investors think, and you're getting it for a pretty cheap multiple right now. The fifth stock is a stock that probably will have a hard time 10xing in value over the next decade, but I think it's just steady as you go. That is Verizon. 6% dividend yield, and don't look now, but the stock is actually up 16% so far this year. That's on top of the dividend that investors have been collecting. But Verizon, I think, is really well positioned for the future of media, and in particular, the bundle that they're going to be able to bring to customers. So the pressure that Verizon has felt over the past decade or so is that they were basically a commodity supplier in the 4G market. There wasn't a lot that differentiated them from anybody else, so they have to subsidize people buying smartphones and other devices that are going to be connected to their network. Yes, that's a very high margin business, but when you keep coming back and subsidizing those purchases of devices every 2 or 3 years, that makes your business profitability much, much lower. So that's why the returns on the capital the company has been putting in the ground haven't been particularly high, but that's changed over the past few years. And what's really changed is that smartphones are still going to be the foundation for Verizon, but on top of that, they're going to layer broadband for homes and businesses. Now, I've been using this for a couple of years now. It's faster than cable is where I live. And basically, if there is a cell connection, particularly a 5G connection available, that's going to make it possible for Verizon to reach into the home and be a broadband supplier. So if you're offering both of those products to customers, what's the natural extension? That's streaming. And that's where Verizon could potentially create a really attractive bundle for everybody in the ecosystem. Smartphones, broadband, and then streaming services. We're starting to see this more and more. They have these add-on services from Disney, from Apple. Even Netflix has joined that. And I think that's really going to be the future of Verizon. You're going to have smartphones continue to be kind of an under pressure business, but the benefit of broadband is there's no added cost to building that broadband network. You're using the same wireless infrastructure that you have for smartphones. All you have to do is get this box that's sitting right next to me and plug it into the wall, and then you have 5G access throughout a home or a business. Streaming is going to be another business, just incremental revenue and margin for Verizon. Don't have to build anything out. They're just going to take a small cut of everything that those streaming companies are going to provide in their bundle. So I think Verizon much better positioned from a strategic perspective than they have been over the past decade or so. And the stock's pretty cheap right now. PE ratio is about 17. We should see their net income and free cash flow increase over the next few years as they reduce the amount of capital expenditures building out that 5G network. I would like to see them pay down a little bit more debt, but we'll see if they're going to do that. They did announce that they were going to buy a fiber company, so that goes into that strategic move again, getting not only smartphones, but also that broadband connection and streaming. So look for this to be a much better performing stock than you might have thought in the next decade. The sixth stock today is MGM Resorts, and there is a ton of value in MGM. If you are a regular watcher of Asymmetric Investing, you know that this is one of the companies that I really like and I think is very misunderstood for a number of reasons. First of all, MGM has exposure to Las Vegas. They own about half of the Las Vegas Strip. They also have a regional business in the US, and they are one of only 6 concessionaires in Macau. Now, they're one of the smallest concessionaires, but they do have a double-digit market share and a very profitable business there that just spits off cash year after year. On top of that, they are building a new resort in Japan, should be open around 2030. That could be the most profitable resort and casino in the world, generating somewhere around $1 billion in adjusted EBITDA or cash flow coming from that resort when it finally opens up. And for all of that really solid strategic positioning, not a lot of supply coming into the market in any of those markets. So as long as people are spending more on entertainment and travel over the next decade than they are today, which I think is definitely going to be the case, MGM should be very well positioned. And investors are getting a really good deal on a trailing 12-month basis. The price to earnings multiple is about 15. Now, one of the big expenses for casino companies is their real estate. So that's a pretty good valuation. Enterprise value to EBITDA is a little under 9. So there's a lot of excess cash flow for MGM Resorts because their businesses are so profitable. Remember, a casino or a resort, you're going to spend billions of dollars to build that up front. When you get to the point that it's actually operational, it's just going to become a cash flow machine. It's just like having an ATM in the middle of the desert if you're in Las Vegas. Traditionally, that money has gone back into building the next casino. Well, right now, there really isn't a next casino. We're not seeing a lot of expansion in Las Vegas. We're not seeing a lot of expansion in Macau. Japan is the only one that's on the horizon. But most of that investment is going to be done in the next year or two, and then the project is going to be finished with debt. So MGM, very good balance sheet, not a lot of debt on the balance sheet. They do have rent payments due each year. Remember, they sold a lot of their real estate to Vici Properties, ended up with most of that. But I think ultimately this is just a cash flow business, trading at a really good valuation. You can see here the company has been buying back stock at an extremely rapid rate. I would expect that to continue. So that stock buyback alone could help drive earnings per share up 10 to 15% on an annualized basis. And weakness in the stock actually means that management is able to buy back more and more of that stock at a really attractive price. So I think MGM, great risk reward balance for investors right now. 7th stock is Uber. Market cap is a little under $160 billion. So very, very valuable company. But think about the networks effects that you have with a business like Uber. They have clearly beaten their biggest rival, which was Lyft. And so now they're able to expand on those network effects, move into more markets. We've seen them do that over the past few years, particularly with food delivery, but you also have all kinds of other delivery services. And the thing that I think could potentially provide the next level of growth for Uber is actually these partnership with autonomous driving companies. They've announced two of those recently. One of them with Waymo. They actually have vehicles on the ground. You're able to get those in a couple of cities around the US, and they're expanding into a few new cities. The interesting part of the recent announcement with Waymo is that Uber is actually going to be operating those vehicles. So Waymo is going to provide the technology, they're going to build the vehicle, and then Uber is going to be the day-to-day operator. That puts Uber in a much better position than they are if they're trying to basically build two networks at the same time, where Uber is building its own ride-sharing network with these autonomous vehicles, and then they're offloading some of that supply to Uber. Now all of that supply falls under Uber. They could potentially be the marketplace or the aggregator for the autonomous driving market. Cruise also falls into this. They have another agreement with Cruise. Cruise is going to be a little bit more separate, where Cruise is trying to build its own ride-sharing fleet and its ride-sharing service where you can call a vehicle on the Cruise app, but they will be offloading some of that supply to Uber. So depending on how this plays out, very possible that Uber will be the company that is the touch point for most people reaching autonomous vehicles. And there could be dozens of companies that are providing those autonomous vehicles to Uber and its ride-sharing fleet. So I think that puts them in a really interesting market. Stock's relatively expensive on a trailing 12-month basis. Price to earnings multiple is 82. Forward basis, it's about 38. So not the cheapest stock out there. I would definitely like to get it at a lower price to earnings multiple, a lower price to sales multiple, which is about 4 right now. So I'd look for any weakness as another buying opportunity, but I think just really well strategically positioned company today in Uber. Now with number 8, let's stick with the big tech theme and go with Meta Platform. The company just continues to perform extremely well. Yes, the stock has gotten much more expensive as the stock has risen over the past couple of years, but Mark Zuckerberg just knows what he's doing with this business. He has a vision that he's executing. They just announced their Orion glasses, AR glasses. Now those are not going to be available for a few years, but I think the vision to build a new platform on those kind of glasses is the kind of thing the company needs to do to move the Reality Labs forward. And Reality Labs is really what's producing a lot of their artificial intelligence technology. It's ending up in their Ray-Ban glasses and now these Orion glasses. Obviously, you have the VR headsets that have been mixed bag results there. But I think the future is Meta trying to get out from under these other platform companies like Apple, where they have to have just an app in their app store, and then you have to follow their rules. They don't want to be under the thumb of these other big tech companies. They want to create their own ecosystem. At the same time, Meta's business is doing extremely well. You can see here that since 2014, the compound annual growth rate is nearly 30%, just a phenomenal growth rate. There was that blip in 2022. That's when you had app tracking transparency come out. But the revenue has re-accelerated over the past year or two. At the same time, Meta has cut costs in a lot of different ways. That's resulted in that increase in free cash flow that you see, almost $50 billion in free cash flow over the past 12 months. And that's on top of all the investments that they're making in their data centers to power artificial intelligence. Meta is in a really interesting position when it comes to things like AI because they can open source their models and basically use a scorched earth strategy to make sure that most of their other competitors are not able to create value with those models. So OpenAI, how do they respond when Meta says, hey, you can have this model for free? There's not a great response, and that's why Meta's Llama models have become some of the most popular artificial intelligence models in the world. Meta doesn't have to make money on the models themselves because they have a business that can benefit from artificial intelligence. So anybody that's building on the AI ecosystem, on these Llama models, is going to make Meta's ad platform better, make the advertisements better, make the copy better. Lots of ancillary benefits that ultimately end up accruing to Meta platforms. But the end of the day, this is really a bet on Mark Zuckerberg. He still controls this company. And I think what they showed last week with the Orion glasses make this a much more compelling business because there is at least a vision forward. And investors are getting the stock at about a 30 price to earnings multiple. And again, this is a growing company. There's not going to be any new competitors in the social media landscape. So I think this is a pretty safe business as far as tech goes. Trading at a reasonable valuation with a visionary founder, that's a great combination for investors long term. The ninth stock, Airbnb. This is the one that is very much overlooked by the market right now, and there's a number of reasons for that. It seems like investors are thinking that competition is going to come in, particularly from companies like Booking.com. Growth maybe isn't what investors were hoping for in the second half of the year. That's as a lot of consumers pull back on some of their spending. But these are all really short-term dynamics, especially the revenue growth. Is revenue going to grow at 8% this year or 11% this year? Well, over the next decade, it doesn't necessarily matter all that much. What matters is Airbnb the go-to platform for people looking for a place to stay that isn't a hotel. And I think that is absolutely still the case. The company has a ton of optionality to grow into other markets. They're getting more and more into experiences. Are they going to add in other ways to travel? They've talked about this travel concierge concept where maybe Airbnb could handle all of your travel and you're just communicating by talking or texting with an AI agent who is able to do all those things for you. Think about a travel agent, but it's artificial intelligence. I think that's a really compelling business model option for them. But we're talking about years before that actually impacts the business. That's why getting Airbnb today at a 17 price to earnings multiple, enterprise value to sales multiple is a little under 7. This is a highly profitable business. Very good cash flow business. Actually has a negative cash conversion cycle, which means that people pay for their stay ahead of time before Airbnb has to actually pay that money out to the hosts that these people are staying with. So that means that Airbnb has about $20 billion in cash on the balance sheet. Nearly half of that is not actually Airbnb's cash, but they're able to collect interest on that cash as it sits on the balance sheet. So phenomenal business model. I think trading at a really reasonable valuation with a lot of potential long-term growth optionality. All of those things are put together. That's the kind of formula to get asymmetric results long-term. So that's why I like Airbnb stock. The final stock on this list, last but not least, is On Holding. This is the apparel company. If you want to know why Nike has taken a nosedive over the past year or so, I think On plays a bigger role in that than you might think. They've got some really compelling shoes. They are now moving into the apparel market. Very, very high end on both of those things. That's why their margins are extremely high as well, about 60% margins. And this is just a growth machine. Management is expecting to grow revenue at about 30% over the next 3 years. That was their long-term guidance. There's no reason to think that isn't going to continue for the foreseeable future, given the options that they have to grow, not only in the developed markets that they already have, like the US, like Switzerland. There's a ton of untapped opportunity around the world for On Holding. And like I said, the next growth phase for them is likely going to be in apparel. I got a couple of pairs of On shoes. I haven't jumped into apparel yet because I've only seen them a few times. They're barely reaching the market now. So you add in that international growth and the apparel growth. I think this is a phenomenal growth company, and the history of apparel companies who go from kind of unknown to being extremely popular is very good for investors. You look at the long-term trends for Nike, the long-term trends for Lululemon. Could On Holding be the next one to do that, to grow the stock 20-30% on a compound basis over the next decade? I think that there's a good chance it can. The stock is already up about 50% in the asymmetric portfolio. That's in a little over a year. So one of the best performing stocks that I have bought over the past year. I think that run will continue for On Holding. So that's my top 10 stocks for October 2024. Like I said, if you're interested in deep dives on a lot of these stocks, take a look at Asymmetric Investing. Check out the free version, and then the premium version is going to give you all of these deep dives, my portfolio, and some more premium content as well. 4+ articles per week coming out. But let's go through that top 10 list and let me know your top 3. I'm curious to hear what you like. Portillo's, Coinbase, Zillow, Alphabet, Verizon, MGM, Uber, Meta, Airbnb, and On Holding. Put your feedback in the comments section below. Don't forget to subscribe here to Asymmetric Investing. And also, don't forget about our sponsor, Public.com, and that bond portfolio as well. If you're looking for more safe investments, income plays, to lock in that rate for the next 3 years, they've got some great options. I'll put a link to that in the show notes as well. Thanks for watching, everybody. See you here next time.